How is going, everyone? In the first video of the series, we learned about what is CRT, how to approach it mechanically, and what its different types are. I hope you all watched that video in detail and have gone back to your charts to backtest it. In today's lecture, we will study in depth which specific candles we need to focus on and how to trade them, as well as on which specific times and days of the week these candles form. Remember, time is more important than price, and that's why when time aligns, everything else falls into place. Alright guys, in today's lecture, we will dive deep into which days of the week we should trade using the CRT model when those candles form and what the trading requirements are. So, let's move to the main lecture. As we know, a single weekly candle consists of 5 daily candles, and among those 5 days, we need to identify which candles to trade. In today's video, I'll teach you about 3 daily CRT models, what they are, and how to catch them. We will cover all of this in this lecture, so stay tuned until the end. We will specifically focus on Monday, Tuesday, Wednesday, or Wednesday, Thursday, and Friday, or Friday, Monday, and Tuesday. Now, why have I mentioned these days and grouped them into 3-day sets? Some of you might already have an idea, but as we move further, everything will become clear. And we know that in a single daily candle, there are 6 4-hour candles, 1, 5, 9, and 1, 5, 9 for Forex, and 2, 6, 10, and 2, 6, 10 for futures. We also know that in one 4-hour candle, there are 4 hourly candles, and the hourly candles you need to focus on are the 1, 3, 6 a.m. candles. PM candles will be covered in the next video. However, in our next video, we will study in detail which specific 4-hour and hourly candles to focus on and how to trade them. But in today's class, we will learn how to trade the daily range as a CRT, so let's move further. As a daily range trader, it's crucial to understand the behavior of both daily and weekly profiles. This knowledge helps you anticipate potential market movements and set more accurate targets. In every trading week, there are 5 daily candles, but not every day offers the same opportunities. By focusing on specific days, you increase your chances of catching the best setups. When the weekly candle is following a classic buy or sell profile, your main focus should be on Monday, Tuesday, and Wednesday for your daily CRT setups. These early weekdays often set the tone for the rest of the week. If you see the price moving in a range during the first 3 days of the week and Wednesday hits a key level, then you can expect a potential reversal on Thursday. In such cases, Wednesday, Thursday, and Friday are the days to watch closely for strong trading opportunities. When Friday closes at a key level, this often signals that a sweep of Friday low or high could occur on Monday. This sweep is followed by a Tuesday distribution, providing a clear CRT setup. In this case, your focus should be on Friday, Monday, and Tuesday. It's important to remember that time is more important than price. When time aligns, the market tends to follow through, making it easier to catch profitable trades. By focusing on these steps in specific days, you can significantly improve your trading and increase your chances of success in daily range trading. So let's move to our first daily CRT model, the Monday range model. The Monday range model is a structured approach for planning your trades throughout the week to capture the weekly range. Here are some steps you can follow to effectively trade the Monday range. First, wait for the Monday candle to close. Once it has closed, mark the high and low as the range. Next, around this Monday high or low, identify a significant weekly or daily key level that could serve as the driving force for further movements. On Tuesday, you need to wait for the candle to sweep either the Monday high or low and close within the range. This action sets the tone for the rest of the week. After the Tuesday candle closes, focus on marking the premium or discount PD arrays within the Tuesday candle range on the 15-minute or 1-hour time frame. Trade the Wednesday candle by buying or selling above or below the Wednesday opening once it reaches the Tuesday PD arrays. Your goal should be to target the opposite end of the Monday range. If you're a beginner, it's recommended to only trade the third candle, Wednesday. However, if you have more experience, you can trade on Tuesday or even on Monday itself. By following these steps, you can create a systematic approach to trading within the weekly range, ensuring you trade with precision and confidence. Okay, let's move to the charts and look at some real-time examples of how the Monday range model works. We are on the US 30 daily chart. This is the Monday candle, which we will consider as our range. Tuesday swept its low and closed inside. So, where is the key level? These bunch of equal lows acts as our key level, so we mark that level and also mark the Monday high and low as our current range. Now let's switch to the 15-minute chart and see how it works and how we can trade it. We are now on the 15-minute chart. The shaded boxes represent candles. The purple shaded area shows candle 1, which indicates Monday's range, and the green shaded area shows Tuesday. Here, you can see as soon as the price hit the key level, it swept Monday's low and closed inside the range. So, candle 1, Monday, is accumulation. Candle 2, Tuesday, acts as manipulation, and the next candle, Wednesday, which will be our main focus and which we trade, will act as distribution. We will also explore what entry models we can use here. You can see this is the turtle soup entry model, but if you're a beginner, don't focus on it initially. Advanced traders, however, can focus on it. As soon as the market took Monday's low and created the turtle soup, then closed above the last thick down close candle, we will mark that as an order block, and that will be our entry model 1. You might have noticed, as soon as the price created this order block and retested it, the price shifted the market structure, so we mark that. After the market structure shift, it created another high probability order block and a fair value gap, so we mark this order block as well. Now we wait for the price to retrace back to our order block. Let's see how it plays out. The price has hit our level, and if we get confirmation here, we will take the trade. Let's see what happens next. Here, the price has created another turtle soup in our zone, so we mark that. Let's see what happens next. Okay guys, the price has recently shown upside displacement, shifted the market structure, and created a fair value gap, so we will mark that. From here, we will open our long position, place our stop below this swing, and target the opposing end of the Monday range. Let's see how it plays out. You can see the price just tapped into our fair value gap, and then, boom. Let's see what happens next. And guys, you can see that our final target has been hit. So, this is the complete breakdown of the Monday range model. Believe me, this is a very high probability model, and if you're watching 2 to 3 pairs, you can catch it at least once a week on one of them. For beginners, I recommend only trading the third candle, when Monday hits a key level, and Tuesday or Wednesday sweeps the high or low of the Monday candle and closes inside. That's all you need. Now, why do I mention Wednesday? Because Tuesday can sometimes be an inside bar. Okay guys, next we're unfolding the Thursday reversal model, a precision-based strategy designed to catch market reversals at key moments within the week. If you're looking to improve your timing and capitalize on market momentum, this is for you. So, here are some steps you can follow to trade the Thursday reversal model effectively. Step 1. Start by marking Wednesday as a range. This gives you a crucial reference point for the week. However, if Wednesday forms an inside bar, then look at Tuesday's range to catch the move. This is where the market begins to set its ranges, and we need to focus on these levels. Now let's talk about Thursday, which will be our main focus. A Thursday reversal typically happens when the market has already reached its liquidity target. This means the market is preparing for a shift, and this is where you need to pay attention. When Thursday comes around, the real action starts. If it sweeps the high or low of the range and ends the day with an inside closing, that's all you need. The best opportunity comes on Friday. This is where you can execute a continuation trade as the market trends in the opposite direction. But for those with more experience and confidence, you can start positioning on Thursday itself, catching the move early. The ultimate goal? Target the opposing end of the range. Once the reversal kicks in, the market will often move swiftly towards the opposite side, and that's where you take your profit. This model is all about timing and precision. It's simple, but effective, giving you a way to trade the week's momentum while managing risk. So, if you're looking to level up your trading strategy, the Thursday reversal model could be your edge. Okay, now let's move to the real chart and look at some live examples of how the Thursday reversal model works. Here we have a daily chart of gold, and the market has already tapped into our key level, which is this fair value gap. Let's go ahead and mark it. This is our Tuesday candle, so we'll mark its high and low as a critical range. And as you can see, Wednesday gave an inside bar closing. This fair value gap is internal range liquidity, and our next external range liquidity is this old high, so let's mark them. Next, we'll switch to a lower time frame and see how this plays out. Okay, we've switched to the hourly chart. Price has already tapped into our key level, and the shaded areas represent the daily candles. The green box shows Tuesday's range, while the blue represents Wednesday, which is an inside bar. So, let's see how Thursday performs, as our main focus will be on Thursday. Let's see how it plays out. Okay guys, you can see that price has swept the low of Tuesday and Wednesday, and the hourly candle gave an inside closing and created a turtle soup. This is our high probability order block, so let's mark it. This is our entry model 1. We've marked the order block, so we will open our long position from here, placing the stop loss just below the order block. We'll target the 50% of Tuesday's range, or the opposing end, so let's see what happens next. Okay, price has tapped into our marked order block and respected it. Our trade is now active, so let's see how it plays out next. Okay guys, as you can see, Thursday has reversed and closed inside, and Friday has opened. I'd recommend beginners focus only on the third candle, which is the Friday continuation. You should buy below Friday's opening by marking the PD array within the Thursday range, and vice versa for a bearish scenario. Since Friday has opened, we are buyers below its opening price. We'll mark the PD array within the Thursday range, and here we have this fair value gap, so let's mark it, and we'll wait for price to tap into this level to open our long position. Let's see how it plays out. Price has tapped into the fair value gap, so we will open our long trade here, with our stop just below. We'll target the opposing end of Tuesday's range. Okay, let's see what happens next. Alright, price has hit our target. We'll hold our trades towards the next external range liquidity, so let's extend them. If you're familiar with my concepts of blending the IRL and ERL with CRT, only then will you understand this, otherwise it might go over your head. If you're a beginner or new to my YouTube channel, you should first watch my videos explaining these concepts, with the link in the top left corner. So, we've extended our trades to the next ERL, and let's see how it plays out. Price has once again tapped into our fair value gap and shown upside displacement. Let's see what happens next. And boom, price has hit our next liquidity level, offering a very high risk to reward trade. Here, you can also see my execution, where I captured a move of over 800 pips using these same concepts. Alright traders, I hope this session helped you grasp the power of daily CRT models. By using these concepts, you can start catching highly profitable moves consistently. Remember, even if you focus on just one model, backtest it thoroughly, and then apply it on live charts to see the results for yourself. These strategies will significantly improve your trading performance. In our next video, we will be unfolding a high probability daily CRT model that can help you catch key market moves with precision. So, make sure you're mentally prepared for that. For more insights and real-time updates, join my Telegram channel. The link is in the description below. Good luck traders, and see you in the next one.